Mihir Vora joins us. Let's say good morning and hello to him. I turned to my left thinking that you would be joining in the studio. I have to look straight because you're joining us via the link. You're not in studio today?
Next time. This time I had some overlaps.
I had ordered a coffee for you knowing what you like. Now what do I do with that?
Thank you, thank you.
There are a lot of overlaps in the market also, isn't it?
Yes, I think the problem is that especially the global markets are all over the place, and they are so schizophrenic. One day they are worried about recession in the US, and the other day they are worried about inflation. I mean, you can't have inflation and recession at the same time, not theoretically. So, they are behaving like, headless chickens at some point in time, especially the US bond markets. And that's what's giving me a little bit of, concern about the global situation. So I think, yeah, it's right now we are being more stock specific, I would say, rather than taking big macro calls. It's one of the toughest environments to take macro calls.
What's next now, Mihir, for the market? Everyone thought that election would be a swing event, which it may not be a swing event. Everyone thought that the earnings season will tell you which way the economy is headed. I'm just trying to understand for rest of the year now, what is next?
So, the hope is that the second half of the year will see a back-ended, faster recovery than expected. While the government is expecting 7% GDP growth, there is a range that I would work with, 6.5 to 7. 7 will be kind of an optimistic scenario. So there are lots of moving parts, and there is some element of optimism on GDP growth already being built into the market. And if that doesn't pan out in the second half of the year post-election, then we might actually, be in for a little bit of a stagnation or correction in the market. Stock specific, of course, there will continue to be opportunities to pick stocks, but a broad-based rally needs to have a broad-based recovery, which is still a question mark right now.
Mihir, right now you're not managing public money, but soon you will be managing public money. So when you will start managing public money, what will you start buying in the fund the minute the fund opens for inflows?
Sure. So the view broadly remains the same, that while we are talking about a range of 6.5 to 7 in terms of GDP growth, and we are saying that 7 may be a bit optimistic, but the fact is that India will be a superior economy in terms of growth compared to the rest of the world. So most of the sectors that we are bullish on are domestic, especially sectors where we are talking about the next 3 to 10 years of runway of growth, where we are talking about more domestic manufacturing, more creation of infrastructure, power infrastructure, road infrastructure, other assets like port, etc. So essentially the domestic investment theme. And then as and when domestic consumption picks up, then the domestic consumption theme also. And this, of course, has to be aided by the financials sector, because without financials growing, you can't see growth in credit in the most of the other sectors. So it's the lifeline. So I think we will stick to those segments. Certain segments like, the ones which we have discussed in the past, like the outsourcing from China in chemicals, pharmaceuticals, machinery, defense. I think those themes are multi-year themes that we'll be playing on. So it really doesn't matter when we launch the fund. At any point in time, we would be buyers in these themes.
Fair point. Best Agro has got a 20, I'm just reading off the flash. Let it stabilize. Some order win, I think. Mihir, in general, if I look at the excitement in PSUs, how much of that is real and how much of that is now euphoria?
I would look at it segment by segment. For example, there are a few in the financial space and some maybe in the infra space also, where they're trading at quite high valuations, and I think it's just because of low floating. So be very careful on that. The energy pack and the defense manufacturing pack, I think, is still reasonably valued because of the potential. The energy pack is cheap in absolute terms. So it's a whole range out there. There are very highly speculative pockets, and then there are more reasonably priced pockets based on the growth potential. So I would, still be picky. I don't think it's a, I can make a statement that the whole sector is cheap or whole pack is cheap or whole pack is expensive. We really have to look at it stock by stock.
I'll like to draw your attention to defense, railways. especially PSU, defense and railways, what is the benchmark to judge them? P multiple, price to book, order book? I mean, what is the ratio one should look at? I mean, for example, somebody is invested in these stocks and you are a fund manager, you are an expert, you understand that how to value these stocks. So if you have to give an advice to value railway and defense stocks for our viewers who own them or who plan to own them, or who want to buy them, how would you give a sense on valuations and the big picture for us?
Sure. So, this theme actually broadly ties in with what we've been, propagating as our investment philosophy, which is that of terminal value investing. People tend to overestimate the short term, but underestimate and quite significantly underestimate the long term in high growth segments and sectors. And that's the value of the stock, which is visible or which can be calculated after the medium term of 3 to 5 years, to say 7, 10 years down the line. What will be the growth rate beyond that is something that we need to think about when we are talking about growth stocks and growth segments. So what happens is that in emerging segments, or and I would say defense, for example, is the emerging segment because it was all PSU, all local manufacturing for local supplies, and that also only for part of the demand in India, which was there locally. But now we are talking about a segment where probably only 1/4 or 1/3 of the manufacturing was local. Now the government is saying that we need to entirely shift to local manufacturing. So then the market size addressable itself goes up by 4-5 times. Then we are talking about the fact that we are going to increase our defense expenditure. And we need to, of course, based on the modernization plan, etc. So then the market doesn't go by 4-5 times potentially, but even more than that. And then we are also saying that private sector will come in. There'll be partnerships with private sector and the public sector, and even the public sector outfits can or should plan to export from India. Now, if we are talking about the export potential, then we are talking about a market which is not 2 lakh crores or 3 lakh crores in size. We are talking about hundreds of billions and trillions of dollars. The whole global global defense spending is $3 trillion. So that, depend, if you can guess or if you can put a finger or estimate what is the potential after 5-7 years when we actually open up big time into exports. It takes a little bit of time to get the things empaneled, but once it happens, then sky's the limit. So terminal value investing is all about that. I think defense, for example, is a classic example. So I'm not saying a P of 20, 30, 40 is cheap or expensive, but what we do need to keep in mind is what is the total addressable market after 5, 7, 10 years.
You see this kind of a large addressable market opportunity?
Absolutely.
Now, where else do you see apart from this?
See, anything in manufacturing, India's total manufacturing base is just $500 billion. And even the US with one-fourth our population is 2.5 trillion. The whole of Europe combined is 3 trillion. China is 5 trillion. China manufacturing is 10 times India's manufacturing. And if multinationals want to shift 10% of China to India, it means that they'll shift 500 billion from China to India, which means that India will have to overnight double its manufacturing capacity. So if we are talking about this kind of shift, plus the 7, 8, 10% domestic demand growth, then manufacturing in India, whether it's chemicals, pharmaceuticals, machinery or machine tools, even durables for that matter, it can have a runway of 10, 20 years before we see, single digit growth. So we can grow at high double digit for a long period of time if this, mega trend continues.
Mihir, are we in for double-digit returns for the equity market for 3 to 5 years? When I say double-digit, let's say early teens, do you think there is a reasonable possibility? Is there a probability of 8 out of 10 that we could be in for a double-digit return CAGR for next 3 years?
Certainly, if you're talking about 3 years to 5 years, certainly that's a possibility. Especially in the large cap indices where the valuations are not that bubbly. We are talking about 15% growth for FY25 and maybe 12 to 15 beyond that also. So I think valuations being where they are, which are a little above average, hoping for a 10 to 13% return on for the next 3 to 5 years is not a stretch, I would say.
How would you approach global denominated sectors, metal, steel, to some extent? Let's say pharma is also global denominated.
Pharma is different because it's much more complicated. There are approvals required. There are lots of entry barriers, and India is pretty much the leader now. So I'm not worried about pharma at all. The global commodities are willy-nilly linked to China. And the fact that even for global commodities like steel, US is especially is encouraging local production. So I would be cautious on the global commodities and metals, including oil, because China doesn't seem to be growing anywhere, and I think it's becoming a structural issue given their demographics and the fact that they have overcreated infrastructure and real estate. So there has been a over investment in infrastructure, over investment in real estate, and the demographics are just not supporting it. The hope was that they will shift to consumption mode, which is not happening. The Chinese culturally don't seem to be getting around to becoming consumers rather than producers for the world. So that I think has as a structural problem in the global commodities.
To a fund manager over the weekend, and he said, look, everyone is ignoring the fact that the Chinese currency actually has moved the other way around, and that in a sense could be a big challenge going forward if the Chinese government decides to devaluate the currency. The whole process of manufacturing will take a backseat. Right now it's an advantage which India is getting because of the Chinese currency, and if China decides to devaluate their currency, which they might do to get export back, that could just put a full stop to a lot of great manufacturing export assumptions.
Historically, China has never done, jerky moves. So even if they let the currency weaken, I think it'll be a smoother move rather than a one shot, because the Chinese economy itself is too big, and there are implications on capital flows. If you shock the market, there are implications on consumer behavior of savings. There are lots of illegal ways to take money out if people start getting jittery about the currency, and there are inflation implications also. So I see that as a Chinese shock move in currency as a very low probability event, I would say.
Before we wrap, that coffee which we ordered for you, knowing that you're coming, ठंडी हो गई, अब क्या करना है?
Sorry, could you repeat that?
No, the coffee which we ordered for you, knowing that you would be joining us in the studio, ठंडा हो गया coffee, अब क्या करें?
Save it for next week. I'll be there.
Look forward to it, but I promise you, we'll serve you not a cold coffee, but a hot cup of coffee early in the morning.
Thank you so much.